Hello and welcome. Today I'm sharing how to find high probability bullish and bearish pressure areas using simple price actions, and I will review how to day trade these zones in multiple market scenarios. So if you could subscribe to the channel and stick around for the full video. Candlesticks Shadows can tell you a lot about the psychology of the market participants and should play an important role in your analysis. Long upper shadows are considered bearish shadows. The percent of one or more bearish shadows after a price advance uh, demonstrates that the market could possibly reaching a top. There is not enough demand at higher price to continue to move the price upward, at least for the short term. Long clover shadows are considered bullish shadows. The formations of one or more bullish shadows after a price decline, especially near support, shows us visually that the market could be reaching a bottom. In this case, the wick indicates that lower price are begin rejected. The psychology behind a wick, I've said it previous video. Markets are traders making trading decisions. If you really want to succeed at day trading, when you look at the chart, don't see it as a price movement, see it as a trade making decisions. So let's analyze three stages of the pin bar from the perspective of the other traders. How do traders react to this bar? During and after this info formation, the best way to examine this price bar is to consider the percentage of trades who transacted at the extremes of the bar. Group 1 sold at the bar height, Group 2 bought at the bar height, Group 3 sold at the bar low, Group 4 bought at the bar low. Traders who sold at the high of the bar stage 1 felt like a genius in stage 2. Then they quickly became frustrating as the market moved higher and sold their profits. Traders who bought at the high of the bar stage 1 were consistently watching the bar erode their trading account. Stage 2 was the worst ever. In stage 3, they felt extremely relevant when the bar ended and the way it did. Traders who sold a lot of the bars stage 2 are in the worst case scenario. The market did not move a single tick in the front in their favor. Traders who bought at the low of the bar stage 2 are the happiest. They did not suffer a single tick against them. So in this case of the large wick candles, we can four types of traders. First, sellers who are scared, likely to cover shorts. Second, buyers who are optimistic, likely hold longs. 3, sellers who are demoralized, likely cover short. 4, buyers who are confident, likely to hold longs or even add more. Why is this important? Well, together they are likely to produce buying pressure. The traders who are short want to cover, so they are creating demand. The buyers who want to hold, they are not supplying, at least not without demanding higher prices. The result is a pressure on the market to move up. So the lower shadows reflected the amount of buying pressures. Your job is to locate the buying and the selling pressure zone limited by the lower and upper shadows of the price bars. Although in the previous case I used the pin bar as an example, a strong pressure zone. It is not defined just by one pin bar to find high probability pressure zone. You must not be particularly interested in how a single bar works. You must pay more attention to the appearance of the group of pin bars 7.2, identifying the pressure zone. So the buying or the selling pressure found on the single price bar might not be successful, reliable for the trading setups. Therefore, instead of the single bar, looking for at least three consecutive bars without overlapping upper or lower shadows. Remember, shadows indicates potential buying or selling pressure. When shadows overlap, they create the price zone that is more likely to exhibition the buying or the selling pressure you anticipate. Consider the pressure of the four groups of trading again. When we have three consecutive bars with overlapping lower shadows, the trades undergo the same emotional cycle three times, all within a compact price range. That price range is the pressure zone we are looking for. A bullish pressure zone is easy to identify. You can mark out as a zone on your chart one. Find three consecutive bars with overlapping lowest shadows. Second, mark out the lowest low amount, the three bars 3. Mark out the lowest closing price of three candles bodies excluded to the shadows. 4. There are between these two prices levels is the bullish pressure zone. To find bearish pressure zone where 3 consecutive bars with overlapping upper shadows. Second, mark out the highest amount the 3 bars. 3. Mark out the highest closest to the 3 candles bodies exclude shadows. 4. They are between these two prices levels the bearish pressure zone. Very important. Small overlaps of shadows can create unreliable pressure zone. To avoid them, ignore overlaps below certain threshold. For trading higher time frames, 1 hour and above, consider increasing the hold as necessary. There's a long pressure zone trading part 1. Find a bullish pressure zone, zone 2. Buy above the next bullish bar that overlaps with the pressure zone and close above it. The third bar, the pressure zone, is acceptable if it is bullish. If the pressure returns once again to the bullish pressure zone and forms another signal candles, you can re-enter. This is similar to supply and demand trading. Third, if price breaks below the pressure zone, the setups becomes invalid, and there is a short pressure zone trading. 1. Find the bearish pressure zone. 2. Sell below the next bearish bar and overlapping with the pressure zone and close below it. The third bar of the pressure zone is acceptable if it is bearish. If the price returns once again to the bearish pressure zone and forms another signal candles, you can re-enter. 3. If price breaks above the pressure zone, the setup becoming invalid. There we have an uptrend. This slight high maintained the excellent bullish momentum by moving above the previous swing high. After such a bullish move, expect the market to react with some bearish or sideways actions. This low that formed could not close below the previous pivot low, implying that uptrend is still intact, and there's our bullish pressure zone. This consecutive wicks signified that the sellers are able to push the price down. Bullish drove price back, showing strength since bullish overpowered the selling pressure by bears. There is a potential that their strength will carry forward, leading to the upwards momentum in price. This is the signal candles which overlaps with our pressure zone, so we buy above it. The low of the extended week provides a very prudent level for you to place your stop. The rationale for the stop placements being a seller pushed price to the low of that weak but could not push it beyond that point. Hence, placing the stop just below that wick is level that has lower likelihood of getting hit. How do you know when to exit? This is probably the most difficult question to answer. It will depend based on your risk tolerance. Sometimes it's best to trade your profit quickly and walk away. Other times you want to take some money off the table, move the stop to break even, and let the trade run. These corrections will be up to you. This example shows the bearish pressure zone setups. These bearish bars formed the pressure zone and gave us opportunity to short the market. This was the setup bar as it overlapped the area and was also bearish. The short trade and the decision flow through, and as the markets pulled back upwards once again. This was an excellent point, especially for the traders who missed the first bearish pressure zone setup. The advantage of this strategy is that the pressure zone plays less emphasis on the length of the signal shadow and instead focused on the multiple shadows to find reliable signs of bullish or bearish pressure. But this price pattern has an important drawback. Consecutive bars with overlapping shadows also occur frequently within congested markets. Instead of taking signals and trades all over the place, the better trades usually happen at the key price levels and when you also take volume in the account. So location of the pressure zones and volume are very important to filter those bad zones that are offering false signals. A good filter without be a common moving average, 200-150 periods moving average, or even VWAP are worth having on your chart when it comes to finding the key pressure zone. During range moving average lose some of their volatility, but during trending markets you will see that those moving average will work very accurately. So try to buy bullish pressure zones above common moving average and see a pressure zone below the common moving average. Higher time frames support and resistance levels and the zones add the great layer of additional confirmations and confluence to the pressure zone. I especially look for the strong and impulsive turning points when price has previously shown a strong reaction, because it impulses that there are a lot of the buyers and the sellers interests in such area, and the price is likely to show another reaction as well. Trend lines and channels are also great confluence areas. Trend lines are especially valuable if you are looking for potential pressure zones during trending markets when it comes to finding re-entry opportunities during pullbacks. When it comes to drawing trend lines, go for the most obvious ones with the most touches. My favorite dynamic support and resistance levels are pivot points. Pivot points are based on the previous day's highs, low and close to they don't change throughout the current day. I mostly pay attention to the central pivot point and S1 and R1 levels. So when you spot the pressure zone that forms pivot levels, that's a high probability trade. Also, the take profit aspects becomes much easier to exit part of your positions and next pivot levels. If you found value or learned something new, I will also like to show your support and check the until next time.